Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. Your hosts this morning are Christoph Barnett and myself, Simon Cordery. I'm delighted to be joined in the studio this morning by Grant Williams. Grant is the co-founder of a company called Real Vision. This is a slight change to our original programming schedule, but we do hope to bring you a conversation with the Ministry of Finance at a later date and hopefully update everyone on some of the more recent developments that have been in the world there. Today's show, though, is going to explore the challenges the world faces from the perspective of a regular investor. Is the world a good place or a bad place to invest today? Is it a dangerous place to invest? Before we get into all that, let's welcome our guest. So, Grant, very good morning and thank you for joining us.
Simon, it's a great pleasure. A little early, but it's a great pleasure.
Thank you. So, Grant, perhaps I said that you're the founder, well, one of the co-founders of a company that recently established here in Cayman called Real Vision. What's your background and what made you establish Real Vision? What's it all about?
It fits very well to what we're going to talk about today, I think. I'm a 30-year finance veteran. I've been in finance for the last 30-odd years around the world, mostly in Asia and the US, some time in Europe. And myself and my partner, Raoul Powell, were talking about 2008, essentially, and what happened in 2008. And we were kind of agitated at the fact that the public particularly were very poorly served at that time in terms of the quality of the information they were getting. There was this narrative that this came out of the clear blue sky and nobody could have seen it coming, and nothing could be further from the truth. There were plenty of smart guys that could see this coming and were warning of it beforehand, and they just didn't have the opportunity to get their views out there and get directly in contact with the public. So we figured we'd try and start something that's a video on demand platform that would give ordinary investors access to some of the really smart financial minds that normally professional investors are the only ones that get access to. So that we set it up about a year and a half ago, and it's going great guns, and we've kind of struck a very good chord with the public, and the business is here in the Cayman. We've got staff here, and it's a fantastic.
And tell me, there's many places in the world that you could have set up a company such as this. Why did you choose Cayman? What was the incentive and the reasoning to select this community? And the reason I ask is there's a big debate that happens in perhaps every country, but why do companies choose to establish in one versus another? So what was the thinking in your mind, in your partner's mind, as to why Cayman?
The Cayman Enterprise City is a phenomenally accommodating organisation. They're set up to encourage people to open businesses here. A lot of our audience is in the United States. This is a great time zone for us to be on, and the US is not a place you go into lightly in terms of getting into that tax regime, into that regulatory regime. And the Cayman is a fantastic alternative on a very similar time zone with a great structure. So and first world services, internet and that kind of stuff. It worked for us very well.
Now, this is a video on demand platform. You're not by background a videographer or a producer. So tell us a little bit about your background.
Well, as I said, I've been in financial markets for 30 odd years, mostly on the equity trading side, but I've worked in the bond markets, commodities, and the beauty of this is these are conversations. Just like we're sitting here talking, I don't need to be a videographer. We have a guy that does the film side of stuff for us. We just talk to people, and it's amazing how open and candid people will be with their knowledge when you just sit down and talk to them. It really is not a complicated idea.
Okay, well, let's switch gears a little bit and perhaps try and solve some of the world's problems that we're facing today. So let's start off with an easy question. Brexit, which for those who are not familiar with the terminology means Britain exiting the European Union. Now, in a community like Cayman, which is still, perhaps despite some of the comments that have been made by the leader of the opposition in the UK, still a British overseas dependent territory. And I suppose if you listen more intently to the former business secretary, gunboats aren't going to be sent to Cayman, but Cayman would be impacted from Britain exiting the European Union, presumably. I mean, Britain would be impacted itself, and as an overseas dependent territory, we wouldn't be able to strike our own deals and arrangements with the European Union. So what would you think? What do you think the implications are, firstly for Britain, and then perhaps more globally, perhaps for Cayman?
Well, I think it's very, very important to understand. Nobody knows what the implications are of Brexit. Right now we don't know, because even the process for leaving, the timeline that will take, is up in the air. No one really knows. But I think what's important to understand is that there is a cycle of prosperity in the world, and a lot of that cycle of prosperity, it comes and goes through history, but it's largely funded by credit and debt. And if people are able to borrow money, it tends to have this wealth effect that lifts all the boats higher. And the EU was a very noble idea with great intentions that was put together in times when you had this wave of prosperity behind them. And so when it was established, it allowed a lot of countries that couldn't have access to cheap credit and cheap debt to borrow money at much lower rates and increase the prosperity of their people. As that cycle turns...
But was that real prosperity? Because you say
borrow
money.
No, because look, it's a great question. When you borrow money, if you hold it through the cycle and you don't pay it back, it becomes a problem. And that's where we are in the cycle. We're at a point where there's an incredible amount of debt in the world. And so as the strains of that debt overhang start to push against the European Union, the flaws are exposed. And that's why we're getting referendums in Holland, and we're getting the Brexit possibilities, and we're getting extreme politics are rising in the right, and there are all kinds of problems. We don't know what the ramifications of a Brexit are, but in a world where everybody needs to trade with outside trading partners, it's certainly not going to be a complete disaster for Britain if it does leave the EU, because everyone's going to renegotiate their own trade deals because they have to.
Wouldn't those trade deals, so playing the devil's advocate a little bit on that, wouldn't it be rational for the European Union to be a little bit more aggressive and offer a slightly worse deal to the UK should it exit its own club in the first place?
Well, look, it's a possibility, but you have to take a long, hard look at the straits that the European Union is in. I mean, it's in a position where its strongest economy, Germany, which has really carried the load through 2008, through the crisis they had in Europe in 2010, 11, all the Greece situation, that economy is starting to weaken noticeably. And so when you have the strongest member of that union starting to enter what looks like a downturn, we don't know how severe it will be, the strains are only going to get magnified. They are going to need to strike deals with people. So they may not be in a very strong position to do these deals. It may just be a very fair negotiation. We just don't know. This is the problem.
I guess that's the problem for a community like Cayman, isn't it? Where people in Britain, probably the politicians, have no idea what's going to happen, what the implications are. Perhaps they may say differently. But then there's a second derivative impact on Cayman. Well, if Britain doesn't know what's going to happen to it, how can we possibly know what the implications are for someone like ourselves?
Well, look, I think that's absolutely right. This is one of those situations where nobody has an answer, but everybody has an opinion. And those opinions are both polarized and very, very strongly held. And so you're going to get an awful lot of, let's call it propaganda from both sides. Project Fear, as it's called in the UK, is the Remain campaign. But at the end of the day, Cayman is going to have to do what it needs to do to survive and to thrive. And initiatives like the Cayman Enterprise City are a great way to do that. You look at yourself as a company, and you look at yourself as a business, which is, I've spent a number of years in Singapore, which has been a phenomenal success story in terms of growing what was a very poor nation into a first world power. And they've done that in a very simple way, by treating the country like a business and making decisions that a businessman would make to advance and grow his business. And it's worked, as I said, phenomenally well. So I think for Cayman, although you are going to have these issues where you're not a sovereign nation, in terms of the local community, the local business, you can make decisions at that level. And if you make them with the right end game in mind, you can still navigate the Brexit without, hopefully, too much pain.
And you mentioned something there about Singapore, and I want to segue to that and then come back to some more sort of geopolitical and economic type questions. But Singapore, and you're right, I think, which is that Singapore has been an incredibly successful story in a really short period of time.
Yeah.
What do you think it can teach to other smaller independent country or quasi-independent countries about how to run their affairs, things they should be doing in order to be prosperous and continue their prosperity?
Well, as I said, I think the key to Singapore's success, and there was a great piece I saw on the internet a little while ago which compared Singapore with Cuba when they both basically became independent, quasi-independent nations around the same time. And there was a set of photographs of each country taken in 1950, 1960 or something. And there were very similar skylines, very similar, poor countries, small populations. And then you fast forward to today, and the Singapore skyline is famous around the world, and it's growing daily. I mean, it's an extraordinary thing to see. And the crucial thing to understand is that Singapore, which had the same prime minister for most of its life, it was 50 years old last year as an independent country, And that man, Lee Kuan Yew, who's an extraordinary individual, ran the country like a business. The decisions he made were for the good of Singapore Inc. He didn't get too caught up in populist politics, and he had the mandate to do that. And it was an incredible time for the country. Interestingly enough, we've just started to reach the point where, having become a very prosperous nation, Singapore is starting to get the pressures you expect to get put on a country, i.e. more welfare state, more government handouts. And it's going to be very interesting to see what they do now. Lee Kuan Yew sadly died last year, right before the 50th anniversary, which is a great shame. But having lost that anchor, that the architect of the country, it's going to be a very interesting time for Singapore. If they carry on doing what they've done and run the country like a business, it's going to thrive. But there are problems.
And so are you saying that a country like Cayman should be thinking about, from a political perspective, organising itself more business-like as opposed to becoming more democratic? I mean, is there a tension that can coexist or can't coexist?
No, look, absolutely they can coexist. And I think people have to understand that business is what grows societies, it grows companies. It's not necessarily government. Government tend to get in the way of business, and not in a bad way. They're there to regulate. They're there to make regulations, but having to do that tends. Your first reaction is to say, well, hang on, don't do that, because we need to make sure this is all okay. We need to regulate it. We need to. I think what Cayman is doing in terms of things like the Cayman Enterprise City, initiatives like that, is incredibly positive for the future. And I think there are great signs here that as a country, the Cayman Islands is going to continue to thrive.
So looking broadly at the world today that we face, what do you think the biggest challenges are that we should be, as a country, paying attention to and making decisions about in order to respond, such that we come out of this troubling time that we seem to be in, where there's uncertainty about growth and opportunities, so we come out of that more successful than we enter? What do you think those challenges are that we need to be most aware of?
Well, I think what people perhaps need to be most mindful of is that we've just ended a cycle of investing, for example, to get wealthier. We're now entering a cycle where people need to preserve their wealth and preserve their purchasing power. And so we had a tremendous bull market in global stocks, aligned with the rise of Asia, for example, the rise of South America. And we've now reached a point where there are a lot of people that have made a lot of wealth over that time, and they need to protect it, because it's we're entering that phase of the cycle where the pressures are going to be downwards, and people need to kind of get out of this mindset where you buy stocks and they go up and you get wealthier, and they need to start being really, really careful about what they do with their money. And having some cash is not a bad thing to do right now. It's potentially not a way to make money because of the low interest rates, but it's a sensible thing to do right now.
Fair enough. Well, I'm going to hold that thought. We're going to come back after a brief break and then talk a little bit more about that, and also particularly in the climate of what could be rising interest rates and the impact that has on people who think of bonds and other assets as safe havens when interest rates rise. What are the implications? So we're going to take a brief break right now. Join us again in a couple of minutes as we talk to Grant Williams.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands and sponsored by One Trade X.
And now, more Money Sense.
Welcome back. In the second half of today's show, we're going to continue our conversation with Grant Williams and explore some more macroeconomic issues that are affecting the globe, but also investors here in Cayman. Just before we took a break, Grant, we talked about some of the challenges the world faces, and you mentioned that there's no harm in being in cash. That we're not necessarily going to see a continuation of stocks going up over a 3-4 year period of time. And we were talking just during the break about what the implications are for investors who might say, well, maybe I should buy bonds, maybe I should hold cash, maybe I should buy other assets. Christoph, do you want to go on to the question then relating to bonds and interest rates and such like?
Sure, absolutely. So, Grant, you were mentioning about the levels of debt in the world and the tremendous growth in debt that we've seen at this point. So, and that's an issue that affects everyone, from investors down to the normal working family. And so we've seen interest rates collapse to zero. Had the Federal Reserve raise rates by 0.25%. But there's always been this talk about, well, interest rates will go back up. Maybe not to the levels we saw in the 1980s, but maybe 4 and 5% is normal. But when you have central bankers printing money and expanding the money supply, and if interest is the price of money, if you have an infinite supply of money, isn't the price zero?
That's a phenomenally good question, and I think the important thing to understand here when you talk about central bankers, if you talk to the average investor and ask them who was the chairman of the Federal Reserve before Alan Greenspan, they probably couldn't tell you. And yet they all know who Alan Greenspan is, they all know Ben Bernanke is, they all know Mario Draghi, Janet Yellen. These guys are now acknowledged public figures, and it shouldn't be that way. They've inserted themselves into the process. And when you say interest rates have collapsed to zero, that implies they went there on their own. Something happened and they just collapsed. That's not the case. They've been lowered to zero to try and stimulate growth. And we can argue this back and forth whether that works or not. The point to understand is with the extreme levels of debt in the world, and governments having to fund more and more deficits and more higher and higher levels of borrowing, they really can't raise interest rates. They're in this trap that they've kind of created for themselves. So when you reach zero, you figure that there's nowhere for these things to go but higher. Then we move into negative interest rate territory, which is a policy designed to penalise savers so that people take their money out of their savings accounts and put it into the economy to try and generate growth. Now, you can argue whether that's a sensible thing to do or whether it's the right thing to do. It doesn't really matter. It's happening. And so suddenly people are forced with a choice as to what to do with their savings, whether to invest it or not. When it comes to interest rates, there are interest rates that are set and there are interest rates that the market set. And at some point, the market takes over the setting of interest rates. People can set the Fed fund rates at 25 basis points. At some point, the market dictates that if a central bank wants to borrow, a government wants to borrow money from the market, we are going to expect a higher return than the one you're paying because we don't think your balance sheet stacks up. That's the tipping point. That's what people have to watch for, is interest rates starting to move of their own volition to places where the central banks don't want them to go.
Well, how close are we to that tipping point then? Because that's for an investor or just a person who doesn't invest or doesn't think they invest, they have a mortgage and they're looking at paying X number of dollars each month on that mortgage. If what you say transpires, they're going to be looking at paying X plus a higher amount. It's going to be increasing amounts. If the market says what you're borrowing is unsustainable, we need to charge more. So where are we in relation to that tipping point, and where do things go from here?
Well, look, it's hard to say, but I think what I'm very comfortable in saying is that we're moving closer to that point every day, and a lot of very, very smart people have been wrong on this, thinking it was going to happen sooner rather than later. But I think once you get into negative interest rates, and take the case of Japan, which has been in a severe economic state for 25 years now. I was living in Japan when the market peaked, and I've seen a 25-year market going down, and the problems there are essentially deflation and a massive debt overhang. When the Japanese central bank went to negative interest rates at the end of January, the immediate reaction of the market was both the currency markets and the equity markets were in the opposite direction to that which I'm sure the central bank had expected them to move in the wake of negative interest rates. And it's those kind of signs where you see a market react instantly and naturally without any spin, without any press conferences. They're the clues you look for as to where markets want to go. And since then, there's been a lot of talk trying to generate this confidence around what central banks are doing. And when you have a market that's held together on confidence in central bankers' ability to maintain the control, which, let's face it, they have maintained now for 7 years. They stepped in 2008 and did what they had to do, and what they did was right. But the effects are wearing off of each added round of stimulus, each added move in interest rates. And so people have to be very, very aware of what could potentially happen and then decide for themselves whether they think it's a probability or a possibility.
Now, you say the effects are wearing off of each additional round of stimulus, but aren't we in a situation actually where there is a reduction in stimulus because of, in the US, there's rising interest rates? So I guess what I'm asking is, isn't the central bank, the Fed, actually going down the path you're suggesting is sensible by normalizing matters, by slowly raising interest rates? Aren't they actually doing the right thing then, according to that argument?
Well, look, it's an interesting point. I mean, when you talk about normalizing interest rates, normal interest rates over the last 30 years are about 4.5%. Now, if you take...
You're talking about Fed funds rate?
I'm talking about Fed funds rate.
So, because the normal interest rate on a house, for instance, or a mortgage would be probably 2 or 3 percentage points higher than that.
Correct.
So right now people are paying perhaps 3% on their mortgage. Historically, on that, what we were saying, they would be paying about 7%. So if we were to revert back to the normal, people would be seeing a doubling or more in their average mortgage bill.
Absolutely, and that's to the point earlier. That's the problem here. That is the issue with being able to raise interest rates. Now, if you have a fixed rate mortgage at these levels, and bear in mind the bond markets are at 500-year highs, and so when you think of something that's trading at the highest it has in 500 years, the risk reward of being long of that asset at that price versus either not being long of it or being short of it, the risk reward is heavily skewed one way. To try for governments to try and maintain an asset at 500-year highs is difficult enough. To do it when they essentially have to do it because things will become unaffordable very quickly. That's why this is such a dangerous situation for the world to be in.
So what, if you were to take that argument and you sort of roll it forward and things didn't transpire in a positive way, what is the worst case scenario that we could be facing? What could happen that hopefully wouldn't? Hopefully something changes that makes it all right and everyone lives happily ever after. But what could the worst case scenario here be?
Well, look, it's no one likes to be a fearmonger, and it's a very fine line between talking about possibilities and then handicapping them as probabilities. And we saw in 2008 what can happen. It hadn't happened since 1929 or since the 30s globally, mainly in the United States. So that was a warning shot for people. And could we see another 2008 event? Of course we could. We could have seen it at any time in the last 20 years, I guess, once the amount of debt had reached certain critical levels. Could we see another event like that? Yes, we could. And people, hopefully, having been through 2008, are aware that it is a possibility and are aware that things can come unglued. And having had such a close shave in 2008, are prepared to take action, which largely means protecting your wealth, going to cash, selling assets, selling equities, reducing leverage is the key thing. And for everybody, it's a question of how likely do I think this is going to happen? And if I think it's more than a 50% chance, I really need to do something about it. If I think it's more than a 25% chance, realistically, you have to think, okay, the ramifications of me being wrong are so high that I just need to be careful about things.
On a more positive note, I guess, it's, of course, debt, we look at it, and there's a lot of negatives that go along with that. But I think that in the world we see ourselves now, with the low interest rates, with the collapse in commodities and low price of oil, it's actually an opportunity for a lot of people who can to reduce their leverage. So the expense complex of the normal person in terms of the decline in oil and commodities provides effectively a tax cut or a raise effectively. And then on your mortgage, interest rates are low. Simon, you mentioned 3% as opposed to 6%. So that's an opportunity to, obviously, if you're buying the house, you're getting into more debt. But if you have debt, to take advantage, to de-lever over time. And so as long as this situation means, so every month that oil stays low, the electricity bill stays low, every month that interest rate stays low. And now, are people doing that? Maybe, maybe not. But
well, this is crucial. This is crucial to understand, and this is a very key problem that the central banks have, because human beings are remarkably smart and remarkably resilient and very adaptable. And so what's happened is people understand that. They are getting a tax cut from the lower oil price. They are facing and looking at generationally low interest rates. What the governments and the central banks want them to do is to take those tax cuts and spend them, get them into the economy. But this is the problem. People aren't doing that because I think inherently they understand it, and a lot of that may be echoes of 2008, but people are taking these savings from their gasoline bills and they're putting them in the bank. And that's not great for what the central banks are trying to do in terms of generate spending and generating leverage to grow the economy. But it's a very sensible thing for people to do, and people are doing the smart thing. Even if they don't really realize what they're doing, they just kind of, great, I saved $20 this month, I'm going to keep it in the bank. I'm not going to go and buy another iPod or buy a bigger car. It's happening, and what the central banks are trying to do is essentially push against human nature. It's a very, very difficult thing to do.
Let me switch gears a little bit. We've got a few minutes left before the show, unfortunately, has to end. But how big an influence or risk factor do you think the current state of politics globally is? When you look at the US, there seem to be people running who, in times past, wouldn't even have got through the first round of a ballot. wouldn't even have been allowed on a ballot paper, perhaps, in some cases. In Europe, in Spain, there isn't a government really. Belgium hasn't had a government for a number of years. Other countries are at risk of having popular uprising. How big an influence or risk factor is this when you put into context what you've been saying about the over-leverage that exists and the actions that need to happen but can't happen? Where's your thinking on this?
Well, it's a very interesting phenomenon, and I think I would flip the question around. When you talk about how big a risk factor is it is now a risk, but before it was a risk, it was a reaction. These extreme politicians have come out of dissatisfaction and unrest. It's come out of the hollowing of the middle class, which I have to say are all a direct result of the policies that have been put in place in 2008 to arrest the decline. We've seen this penalisation of savers, who unfortunately for governments tend to be the people who vote the most. And so yes, it's become a risk. Extreme politics in Europe, particularly a country which is surprisingly unstable, like France. You've seen a very far right candidate make huge inroads. Holland, we've seen it. It's not as extreme in the UK with UKIP, but they've certainly made enormous inroads, both into the left-wing parties and the right-wing parties. And then we can talk about the clown show that is the United States. I mean, to sit and tell someone 5 years ago or 10 years ago that the two candidates causing the most noise would be Donald Trump and Bernie Sanders, no one would have believed you. And yet here we are. And there's a very real and I think perfectly understandable reason why we've seen this rise. It's a dissatisfaction. It's a fact that people are being told on the one hand that things are getting better and the economy's strong, and they're feeling exactly the opposite. They're feeling that their savings are dwindling. They're feeling they're not getting any return on holding cash. They can't be safe. And so, yeah, I think the political thing is a risk, but it's an understandable reaction to a set of circumstances that have manifested themselves over the last sort of 5 or 6 years.
Is it something that can be fixed, or are we going to be facing just this problem and then we're going to have to get through it? Or where do we stand in that?
It can be fixed, and it will be fixed. I mean, it always has been in the past. The question is the path between here and it being fixed. Does it take President Trump for people to wake up and go, we cannot let this happen again? I don't know. I mean, that may be what it takes.
Well, I don't want to end on that note, but unfortunately our time is very close to being up. So, Grant, thank you very much for joining us in the studio this morning, and I hope we haven't upset people over their cornflakes with the words Donald and Trump and President in the same sentence. That's a little scary. Now, before we do leave today's show, one thing that we've tried to do on this show over the past few months is try to help people understand a little bit about financial markets, investor information. And as something we're planning to do as a society is we were going to go out next Friday, and we're going to be interviewing people, asking them what financial markets are, asking them what they think financial markets should be and how they should be regulated, what they should be doing, what we should be doing as a community to make them better for the average investor. Now, if there's anyone who's listening to this show who's interested in being interviewed for that purpose, who wants to express their opinion and make their opinion heard, we're then going to be, when I say we, in association with Real Vision, we're going to be compiling those various clips, and we're going to be putting them on as a 15-minute production at the cinema at the end of May. So we're actually going to be doing a real production which is going to be visible for the general public to watch. So if you are interested in giving your opinion on where financial markets are today and what that means for the average investor, please do send us an email and we can give you some more details. And remember, our email address is moneysense@candw.ky. Now with that, our time is up. Our producer is glaring at me and telling me that we need to cut the show now. So thank you very much, Grant, for joining us, and Christoph, as always. Goodbye.